Good afternoon, and thank you for joining us. Today, we are pleased to have with us Dan Oberste, President and CEO of BSR Real Estate Investment Trust, one of Echelon Capital Markets Q4 2022 top picks in the real estate space. BSR owns a portfolio of garden-style apartments in the US Sunbelt. Over the past year and a half, the REIT has benefited from a post-COVID surge in demand, which has led to record-setting rent growth, strong financial results, and share price outperformance. Before we get into the questions, I'd like to turn it over to Dan for a quick introduction and high-level overview of BSR's business. Dan, great to have you here. Can you give us the quick elevator pitch on BSR?
Certainly, David, though I thought you did a pretty good job. So I'll try to remember yours and not repeat it. Yeah, as David said, BSR has 8,666 suites situated primarily in the state of Texas, specifically in Austin, Dallas, and Houston. We also own 4 properties in Oklahoma City and 2 in Little Rock. The chili, the ingredients used to make the chili of BSR really were driven from a community manager, a property manager, and an individual and family-run business that really felt like they understood how to underwrite, acquire, and manage apartments. This business started 70 years ago, and it started with oftentimes how a lot of individuals start, by running a duplex or running 4 or 5 apartments. And over 70 years, we've grown methodically into what is now, in our view, the best multifamily apartment play in the North American sector. We've picked our markets deliberately. We've executed our strategy since 2019, I think near perfectly. And we now enjoy, as you said, sector-leading compound annual growth rates in revenue, driving NOI growth, driving FFO growth, driving AFFO growth. That's exactly the ship that we wanted to design, and we're really happy. I'm happy to captain that ship right now, and we're happy to keep trudging along, making the right real estate decisions.
That's great. And Dan, BSR is listed on the TSX, but owns a portfolio of apartments exclusively in the US. So for investors who are familiar with the Canadian apartment landscape, but not the US, what are the main advantages and disadvantages of operating south of the border?
Sure. One of the main advantages of operating in the Canadian capital markets is the concept of a bought deal. It's the method in which a public REIT will raise equity. Equity raise is a little bit more transparent and more efficient in Canada. And what that enables the equity deployer to do is to underwrite a specific cost of capital when we're buying something. So we can underwrite a certainty of our interest rate cost and our equity cost before we make an investment decision. That's helped us along the way, and it really helps us assess our weighted average cost of capital at any given time. So I'll say in layman's terms, financing our credit up in Canada and our equity up in Canada enables us to determine more accurately, how much everything costs and whether an investment is going to make more money for our shareholders. I would say a disadvantage really was exposed during COVID. We're south of the border. We're in a separate country. I know that Canada and the United States are very, very similar demographically, socially. We share many of the same social customs. But for a REIT that really rebuilt itself while public during COVID, our investors, our analysts, and much of the Canadian community that follows us were unable to come and see our properties. We're unable to really understand the story of growth coming out of the Sunbelt, and in some cases lagged behind US investors in both valuing our assets on the street from a NAV standpoint, as well as from a stock price standpoint.
And Dan, you mentioned reinventing yourself through COVID. Since the 2018 IPO, BSR's portfolio has undergone a significant transformation to now focus predominantly on newer generation assets in Texas. What's so attractive about the Texas market, and are there other markets you like and would target for expansion?
Sure. Well, let's first of all, David, say that our thought on real estate investing is pretty simple. Compound annual NOI growth, driving down to FFO and AFFO growth, or just cash flow growth, is the number one determinant of value. You can create very complicated charts. You can create very transparent business lines. But at the end of the day, are you growing your revenue? Is that growing through rate increases? Is rent going up? Is it costing less to run your properties? And are you financing your properties correctly? Okay, then you're going to drive your cash flow growth, and the market will time cap rates and values of assets. But we focus on that cash flow growth. I'd say prior to the IPO and up into the IPO, in 2017, we owned as many as 126 properties. And when we went public, we were in 14 markets. So we're pretty well versed on the Sunbelt and the different markets. We deliberately picked Texas because we thought the compound of that Texas triangle represents the 15th largest economy in the world, was the best triangle with which to efficiently deploy capital to generate the highest total unit holder return. That's played out quite well for us. I think we're leading the pack north and south of the wall as far as TUR. By many measures over the last year, 2 years, 3 years, so on and so forth. But our recipe is simple. Is the rent going up? Is occupancy going up? How do you get that property less expensive to run? Well, you buy new properties. How do you get that rent to go up? You buy properties where people are moving to. Why do people move? They move for jobs and affordability. So that Texas triangle afforded the perfect geographic situation. And our product profile was deliberately chosen within that Texas triangle. We've enjoyed the fruits, and so have our investors. I think that when we think about other markets, David, there are plenty of other markets that look and smell and feel like Austin. There are plenty that look like Dallas, and there are plenty that look like Houston. There are not many that are situated 2-hour drive apart that look like Dallas, Austin, and Houston. As a matter of fact, we can't find one. The second we can find another triangle of investment where we can look for yield and look for growth at the same time and manage it to scale and efficiently, and we can drive a higher TUR than what we're being able to generate in this Texas triangle, we will certainly expand into those markets. We've managed many of them in the past. We just hadn't seen it yet.
That's great. And Dan, you recently announced the REIT's first ground-up development project, which is obviously a departure from acquiring existing assets. When you look at your investment opportunities, how do you evaluate risks and returns and allocate capital between stable assets or building new?
Yeah, sure. You answered the question in it. So we look at an unlevered return. Well, first of all, BSR's got 3 business lines. We're a community manager, we're a real estate investor, and we're an asset manager. And unlike many of our competitors, our investors own all 3 of that, as we're an internally managed business. Now, the market places a value on one of these 3. That's the real estate investor. That's okay. Those other 2 lines are what generate our asset management decisions. And that is to say, if we look at an unlevered return in a market for 3 separate types of communities, we're looking at a new development unlevered return, or otherwise a cap rate. We're looking at lease up, and that's a property that's just recently been built, and it might have 20% of its apartments occupied. And then we're looking at a stabilized property, cap rate or unlevered return. And historically, we like to see a stabilized cap rate or a stabilized unlevered return sit at about 150 basis points, let's say 100 to 150 basis points north of our overall cost of capital. Stabilized lease execution risk. You've got the residents already inside the property. The one rung down is that newly completed lease up property, and we like to see a spread of about 50 to 100 basis points on top of that stabilized spread. So we want to see about 200 to 250 basis points, or 2.5% higher than our cost of capital to buy a lease-up property. And then when it comes to a development property, that's a substantial risk. You're buying a piece of dirt and you're building an apartment complex, and you're underwriting and sometimes hoping that 2 or 3 years from now, you'll have a full apartment complex. And when we evaluate those risks, we like to see the spread of yield or unlevered return look to be about 300 to 350 basis points, or 3.5% above our cost of capital. Now, as you can imagine, the world doesn't always work in perfect correlations. So when we see stabilized yields north of where they should be, or right at where lease-up risk is, then that's no execution risk, buy that stabilized yield. And you've seen us do that quite a bit since the IPO. When we see a lease-up acquisition sitting at 300 basis point or 3% spread on top of stabilized, then we'll go for that lease-up. And when we see development yields well in excess of either stabilized or lease-up, beyond that spread that I talked about, David, we'll go after that development yield. Now, 2 of our 3 business lines, our property manager and our asset manager, enable us to take advantage of any one of the 3 acquisition types. That is lease-up, development, or stabilized. And we just mine the unlevered return between the 2. And in a case like today, when we don't think that any of the 3 makes sense, we don't buy. We don't deploy capital. In a case like last year and the year prior, we saw a substantial premium to buy lease-up properties, and so you saw us buy a lot of them. In 2017 and 18, early 19, you saw us buy stabilized assets with an eye towards value-add execution. That's a time where we saw the value for a stabilized property well in excess than that of lease-up or a new. So with us, it's rarely that we coexist in a time where all 3 don't make sense. This month, last month, the month before, they don't make sense, but they will one day. One of the 3 always makes sense.
That's great. And Dan, ESG has become increasingly topical across the investment industry. What is your view of your existing ESG policies, processes, and systems, and where do you see opportunities to improve?
Yeah, thanks, David. Our board and management places a priority on this issue, as with most of our peers. And I think if I was to think about ESG on the left side of my brain, I would say we need to, our goal is to define our societal why and embed it into the core of our business. What does that mean, right? I think we can take it culturally, and we can create an environment where every one of our team members sees an opportunity for professional growth. That's in our vision statement, and we live by that. We can promote internally. We can make very good cultural decisions with our team members that creates a culture of productivity. There's 1,000 different ways to do it that adhere to ESG, right? What it's not to us, it's not a glossy piece of paper. It's kind of I'll say an evolving concept that enables us to do good and well if channeled appropriately. That's a culture issue. When it comes to a real estate investor, an apartment investor, though, one focus that our asset management team has right now as it relates to ESG is ideas ranging from electronic charging stations to on-site power and water generation. Those ideas fit nicely into the core of our business. They generate a return for our investors. They eliminate some of our and our residents' carbon footprint, and that enables the REIT to do good and do well at the same time. So we focus on our societal why, and we figure out how to embed those concepts in the core of our business. Culturally, that's one. It's in our vision statement, right? And then from a real estate investment standpoint, there are ideas that eliminate or substantially reduce our carbon footprint that also show up on the bottom line to our investors.
That's great. And Dan, obviously the last couple of years have seen some great tailwinds for the business. Going forward, what do you see as the biggest challenges facing BSR?
Oh, sure. There's always a topic du jour, right? In any given quarter or year, David. I think right now, we'll probably have to refresh this answer a year from now or 2 years from now, because it's always something different and it's always something, the boogeyman is always out there. Right now, I would break it down into internal and external factors. I think externally, the biggest challenge that our business and our sector faces right now is that we're not immune from credit cost impacting our overall cost of capital. Rising interest rates, tightening, running from a super easy monetary policy to a super tight monetary policy certainly has its effects, right? And it is impacting our business. There are questions about cap rate movement abound. Developers have no idea how to pencil in a development yield. And we have residents and prospective residents that need to find a place to live. Mm-hmm. And it's tough to get them built, and they're not trading. And that's all driven by running from one end of the canoe to the other from a central bank standpoint. External risk. I think internally, I think it's ensuring that we remain in front of the wave of adaptability to a constantly changing workplace environment. As we've seen, offices are evolving more now than they have, certainly in my career, but I would say somewhat in the last 50 years. We've oftentimes said that technology is the great deflator. I don't think people really understood how that would impact the office environment or the cost per square foot of office space. And I think we're all seeing it right now. We have 224 employees. About 200 of them work out in the field. They live in our apartment complexes. They work in our offices. The way we work our common areas and our property offices and the way we work at our corporate offices is certainly up to change and has changed significantly over the last couple of years. And I love how this company and its team members have adapted to that. We should not stop doing that. It is a challenge, but it's a good one. I think 5 years from now, the workplace environment looks absolutely different than it does today. And if we don't stay on the front of that wave, we'll be left behind.
That's great. Dan, as always, great chatting with you. On behalf of Echelon, I'd like to thank you for your time today.
Thank you, David, and thank you, Echelon.